Welcome to Keep What You Earn, your judgment and jargon-free zone for entrepreneurs of all levels. Get ready to learn how to scale your business, save money in taxes, and create a business that grows your wealth. If it feels like the financial side of business is like eating your vegetables, well then think of this podcast as the ranch dressing to make the process a little more enjoyable. My name is Shannon Weinstein. I'm a CPA and business owner on a mission to simplify money and empower others through knowledge. I hope this episode inspires you to take action, but remember that the information we share is for educational purposes only and is not individual tax advice. Now that we got that out of the way, let's start the show. So today we're going to be going through basically what the hell is deductible? What is deductible for entrepreneurs? This is definitely a hot topic. We are in the middle of tax season right now. And frankly, this is when most accountants don't have the time to explain this. And this is yet when most entrepreneurs and most taxpayers have this question and are hyper aware of this question. So I wanted to make sure that you have the resources available to find out what exactly is deductible and how can you be mindful of this going forward so you're maximizing tax savings year-round. So as always, I have to disclaim everything we do. Now, this is from our free tax deduction guide, which is coming soon. So if you're listening to this podcast, chances are the tax deduction guide is out, and we're going to put a link in the show notes. But for those of you who are live on the call today, we are about to launch this, and we will be posting with the replay of this call. We will be posting a link to the guide, but you're going to get a little preview of it today. And the key thing here is really teaching what is deductible. And then the guide will actually take you through several actual tax deductions. I already have over, I think it's 150 listed. So I have over 150 tax deductions that I have listed out for you in that free resource. So I'll be sure to post that as soon as we're done and as soon as we get that out there. So disclaimer is always that this is not individual tax advice. Everything is very unique to the business owner, to the taxpayer and their situation. So you want to make sure that you are getting the right advice. This is like diet advice. This is like fitness advice. It doesn't apply to everybody. There's always a little bit of nuance. So, but we would rather educate the 80, 90% of you that this applies to than have to worry about every single nuance and never educate people. So that's our mentality at Keep What You Earn. And we ask that you please proceed with caution as you implement. So definitely involve your professional in any questions you have as well. So what exactly is deductible? What is deductible? What makes something deductible? And what the hell does that even mean? Okay, so what is a deduction? First and foremost, what is a deduction? This is also called a write-off. So you may have heard there's always that trending audio from Schitt's Creek, right? That's a write-off. That's a write-off. So it's a write-off means writing it off of your income. It doesn't mean it never happened. It doesn't mean it disappears. It doesn't mean you get a rebate. Okay. It doesn't mean the IRS is paying for it. It doesn't mean any of that stuff. What it is a deduction or a write-off. Same exact thing. We just call them different phrases, different words, different terms. A deduction helps lower your profits that you report to the IRS in the context of a business expense deduction. So when you look at your tax return, deductions are things that lower taxable income. And in the context of a business owner, lowering profit. And because you are taxed on profit of your business, you therefore pay less in taxes the more deductions you take, right? Logic. So if you're paying taxes on profit, you want your profit to appear lower than it maybe is in order to minimize taxes. Now, a deduction is not a direct tax savings. It is not a situation where if you take $8,000 deduction, you're going to save $1,000. In reality, you're going to save between $150 and $200. So when you think about deductions, I want you to think about them as a coupon versus a gift card. Okay. So you're going to be getting a discount. You're going to be paying less in taxes ultimately because the price is lower. So that it's like a percentage savings versus a gift card is more like a tax credit. So if you've heard about tax credits are dollar for dollar. Tax deductions are lowering the income so that you're taxed on less money. That is more of the direct and indirect savings of credits versus deductions. So what makes an expense actually deductible? And the IRS has a really, really broad definition, which is unfortunate and yet fortunate. So the problem is that when they're super vague about their guidance, it leaves a lot of room for interpretation. The downside is it does leave a lot of room for interpretation. So if you are ever audited, then the IRS agent can really choose however they want to interpret things, just like you and your tax strategist can. So a lot of the tax game is making a business case, making a defensible business case and saying, this is why we interpret it this way, or this is why we deem this to be deductible. And here's why. And I would say 90% of the strength of any deduction is the case you can make to defend it. So if you are like, I am super confident that this is a legitimate deduction for my business, then that's what matters. And that you can explain it and that you can be confident. The IRS agent may still disagree with you, but if you can show up and you can show up prepared with good documentation and everything, you're golden. We're going to go through that in a little bit. So when the IRS has a broad definition of what makes a deduction, what I mean is that they give these terms that are very, very vague. So right now, the guidance says that the expense must be ordinary and necessary to be deductible. So for it to be a legitimate business expense, it needs to be ordinary and necessary. What does that actually mean? Here's my interpretation, and this is just me trying to paraphrase. Ordinary would be a common expense found to be taken by a business in your industry. So it's typical. It's a typical expense. It's not out of the realm of usual business behavior for someone in your line of work. And necessary would be something with a business purpose in order for you to further grow your profit and grow your business. So ideally, what they're trying to do is incentivize you as a business owner. They want to incentivize you into basically spending more money to increase your profits, or spending more money on things that grow your business, because the government is very pro small business in the tax code. Because what they want you to do is start more businesses, grow more businesses, hire more people, use up more resources, build the economy up, create commerce, all of these things, right? We want to create this vibrant economy, vibrant society. So in order to do that, the government has incentivized us with these different tax rules, one of which is allowing you to deduct business expenses because you've lost control of that money. You have spent that money. So it's not really fair to tax you on that money on top of having you spend it. Most business owners are not making crazy high margins. Like they're not keeping a ton of what they earn. And the government acknowledges that. So this is how we are expected to pay taxes, is on the profit of our business. And ordinary and necessary expenses being anything that you believe you can make a business case for that will further your profitability and is not either frivolous, not extreme. The expense also needs to be a reasonable amount. They don't put this, like it's kind of embedded in this definition of ordinary and necessary. But the other thing too is like, you don't need to spend crazy amounts of deductions on certain things. There are definitely ways that you can spend more money for sure. But ultimately what they'll look for is, you took this huge deduction for, let's say, for your home office, right? You took a home office deduction and they're like, did you really need like a Swarovski desk or whatever it is? Like, if you're taking these crazy deductions, it would have to be super extreme. But I'm saying it has to be somewhat within reason that you would spend this money and that it would be logical to spend that money. So then we talk about what are the risks? Like, if you're thinking, okay, I understand what a deduction is, I want to take all the deductions. What does it mean for me in terms of what are the boundaries? Like, what can I not take? Or what should I be wary of? What should I be paying attention to? And that is going to come into play here with what I call the 3 Ds. You need to have, if you're going to make a deduction, if you're going to claim a deduction on your tax return of any kind, really, but mostly around business expenses, this applies. So if you are going to deduct anything, or the phrase I use is you can deduct anything, but the question is if you want to risk getting caught. So if someone says, is this deductible? I go, you can deduct anything, but how good do you look in orange? Which is clearly a joke because very seldom do you go to jail for taking one deduction. But ultimately, it's a question of how well can you and your tax advisor defend your position? And that's number one. Do you have a defendable business case? Can you defend your exact position? And I actually look at this as kind of this 51% rule I use, which is, am I more than 50% likely to win if I make this argument in a tax court or an appeal, is it pretty likely that I'm going to win based on my understanding of the law and the tax code? Can I support this realistically? And if the answer is yes, then I say take the position, even if it's deemed aggressive by other professionals. And a side note, I would definitely get second opinions if you're ever worried about in a quote unquote aggressive position. If you believe a position is aggressive, then get a second opinion. It's always good to find out, what generally other CPAs and accountants and tax pros are comfortable taking. And then the second one is documentation. Documentation, meaning receipts and anything that shows the business case for what you did. So, for example, in the case of business meals as a deduction, you want to have a receipt that shows I call it the who, what, when, where, why. It's the who are you with, the itemized bill, when did you go there, where did you go? All of this is on the receipt, basically. But the who and the why, you need to write in there. So like dinner with Shannon to discuss tax strategy. So writing that on your meal receipt gives you way more bulk behind your case if you can document that. It really makes it bulletproof. So documentation is key, making sure that you're keeping receipts for larger expenses, making sure you're able to prove who you paid, when you paid, and that you paid. That is the biggest thing. And what it was for. This is what people usually leave out, is what was it for? And this is why I say credit card statements don't cut it, guys. Because the credit card statements will say you paid Target $200 on January 8th. Okay, great. What did you buy? Why is that a business expense? And if you can't show that, then it loses all of its luster. It loses all of its value, because the credit card statement is just going to prove that you spent money. But what you're trying to prove to an auditor is that it was business related, and you need to be able to do that. And then the final thing is, I call it diverse categories. Don't concentrate all of your expenses into miscellaneous, and don't concentrate them all into particular categories on your return. This is a little hack for you. So if you're reviewing your own tax return right now, or your preparer is currently working on it, what I would do is look at how well they spread your expenses across various categories. And this is going to sound like a funny analogy because it's not meant to be literal. But if you got in trouble when you were a teenager and there were like 5 of you in the car, and like you I'm not advocating for this, by the way, and I've never done this, but if you think about it, because I watch a lot of like those police shows. So this is like what pops into my head is like, you're driving in a car with 5 people and you're getting in trouble and the cop catches you. You don't all 5 run in the same direction. You don't all 5 run in the same direction, because then you're all going to get caught. So what you do is you go, okay, we are going to reduce the likelihood of getting caught by spreading out and going in different directions. And while I don't mean this literally in the sense of getting in trouble and the cops and whatever, what I'm talking about is if you basically go in 5 different directions, if you have a contractor's expense, for example, that is massive, if you make $100,000 in income and you have $60,000 in contractor expense and that's it, I would say, okay, hold on a second. Do you have one contractor? No. Do you have, who is this? Like, okay, that's my social media manager plus my VA plus my accountant plus my da, 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 da. I go, okay, great. Let's actually break those out. Let's actually have different categories for like advertising and marketing, for operations management, for whatever. Like, let's actually label these categories separately. And that way, because what will happen is if an IRS auditor comes to you and looks at your return, you would much rather, and so would they, to be honest with you, would much rather if they're going to pick an account to audit, pick a line item, you would rather them pick a specific one. Like you would rather have them pick the 5,000 of advertising expense than 60,000 of contractor. Because if all they have to work off of is that one big number, they're going to grab that and ask for support for every single dollar of that deduction. Versus if you spread it out, they would have to individually select those particular accounts, and they would have more information at that point about how you spent your money, where they could be more conscious of what they pick, and the audit goes smoother for everybody, because now you have a more focused area that they're actually looking at. So I always say, don't use other and miscellaneous if you can avoid it, because that is not telling the auditor or the IRS what exactly you spent money on. That is a really easy one for them to audit, because they go, what is other? What is MISC? Like if it truly doesn't have another category, and by the way, you can write categories in. So if it has no potential label, is it really a business expense? Like, how can you defend that? So it definitely can call into question. So I would, when you're looking at your return, I would definitely consider this, and I would definitely examine how you're taking your deductions, just as well as which deductions you're taking and how it's actually presented, because it's pretty much 90% the business case and 10% how it looks. And you want to make sure that how it looks is also considered, because you could be triggering some type of algorithm. You could be triggering something that's like, hey, she took a huge rent expense. Let's look into that. And it's like, oh, I didn't mean to do that. I could have put like home office reimbursement. I could have put these other different expenses in. So just keep that in mind as you're reviewing your tax return. So I guess in summary, when we're talking about deductions, it's just as important to be able to defend the business case as it is to understand what is potentially deductible. Not everything is deductible for the same expenses aren't deductible for everybody. You're going to have very unique things for your business. I always use the example that during COVID, I was super jealous of my fitness professional friends because I used to work in fitness. It was never my main job or my main moneymaker, but I was working with fitness professionals, and they would go out and buy kettlebells and gym equipment. And I'm like, oh, I wish I could deduct that. But they can, because they're teaching classes from their home gym and they need to buy equipment in order to do that. So I would consider that ordinary and necessary, especially during a pandemic. So for me, though, I could not deduct my Peloton. Why? Because an accountant doesn't need it. And that's where it comes into play with what is your actual business and how can you make a case for why this is relevant to your business, not just, I need to look good, I need to feel good, I need to be alert and awake, I need to be healthy. We all do. But you have to make a strong case as to why this particular business should be able to deduct it. Hey, wouldn't it be cool if you could chat with me and our guests about this episode? Well, guess what? You can. Join the Keep What You Earn community now using the link below in the show notes. You can post your questions, chat with fellow business owners, and the best part, it's totally free. Oh, and by the way, it's not a Facebook group. That's right, no noisy notifications or distractions. Just what you need to get the full experience from listening to this podcast and maximizing your value. Meet us over there after the episode to get exclusive content and access to me and our guests for your questions. We'll see you over there. Thank you so much for listening. If you enjoyed this episode, please leave a rating and review on your podcast platform. This small action goes a long way for podcasters to get our message heard by more business owners just like you. Be sure to check out the show notes for links to information about our guests and ways to get in touch with me. We'll see you on the next episode.